Hello, my name is Mark Best. I'm Head of Creator Experience and Tooling here at Trality, and this is a tutorial video about how to use some of the new margin trading functionality within the backtester. So what we want to do initially is I've started with a bot which basically has a few indicators within here already kind of laid out. So we'll kind of take these indicators, turn them into or allow them to actually trade, and then we can basically, rather than just having a long only bot, create a kind of long short bot using the margin trading functionality. So just as a quick introduction, we can kind of see, we have a standard handler here, we have the initialization. The thing is a little bit different here is the indicator or signal is basically a moving average convergence divergence, but it's just using a different moving average function. So the standard MACD uses an exponential weighted moving average. This will be using a zero lag moving average. And it will be using a fast period of 21, slow period of 144, and then a signal smoothing period of 55. So if we just quickly run this back test, it's also using daily bars, we can kind of see the signals, and then we can see kind of what it does. Also just in here as well, just for a gauge, this will come in important a little bit later, but I'm also plotting basically the volatility using a Rogers actual volatility indicator. This is just a little bit better because it takes into account basically the highs and lows of the bars as well as the open and the closes. So we can see there's no trading currently, and we can see the signal here, and then we can see the kind of volatility model. So what I'm actually going to use for this strategy is instead of actually placing orders themselves, we're just going to actually be using kind of position weight. So what we can do is basically set up the position weight or query it. So what the position weight is just how much of the how much assets are actually allocated as a percentage to a specific asset. So create the position weight. I'm just going to plot that out. So why this is important is what we're actually going to do is we're going to set up a target. So we're going to say we have this MACD signal, and we're going to say basically if this is greater than 0, so if we're in an upward trend, we want to set our target to what is effectively 95% of our portfolio. Else, if there's no positive trend, we want to set our target to 0. So what we're actually doing is just trying to allocate different proportions of our portfolio to the traded asset. In this case, it's BTC USDT, depending on what the actual signal is doing. And then finally, what we want to do is basically we want to say, and this is where position weight comes important. We want to say, given our current position weight and given what we want our target weight to be, we can kind of then work out what would our trade size be. So the trade size is that difference. So it's the target minus position weight multiplied by PV, which is the portfolio value. So, if we don't have a target position and we want to go to 95% and our portfolio value is $1,000, then we basically go 95 minus 0 multiplied by 1,000 gives you $950. So here we just want to say if trade size is greater than some minimum trading amount, let's just call it $20, we can then do adjust position. So this is quite convenient because this is the trading logic here. We can also just create a kind of print statement here just to log out what's going on. It's always preferential to use F strings when printing out because the nice thing is you can always add formatting quite comfortably and much less prone to bugs. So what we just added here is we have the signal. We're basically trying to set a target based on the signal. We're just checking, does that actually require placing a trade of size that's actually not just going to get rejected by the exchange. and then we are going to try and trade. So let's try and run that, see if we get bugs. Yes, we do. Line 54. So the reason it's not happy about this is because query position size is a decimal. I'm trying to multiply from a float. Okay, perfect. So what we can see here is the trades that it's placing. You can see that it's placing kind of small ones and large ones. When it places large ones, you can see that it's flipping from one direction to the other. So we can see now, this is just a simple spot portfolio. We can see that the signal itself is actually quite good at picking out the waves of Bitcoin basically over the last 2 years. So the actual parameter values for this were picked via the optimizer. So it is no coincidence, let's say, that the results actually look quite promising. So what we can see is we basically have a full position during this bull market. When we go into a bear market, it's flat because we're out of the market. We have a zero position. Same in these two cases. So we have these kind of flat spots. So this is the interesting thing. I mean, during basically periods since November 2021, we've been in a long run bear market. It's been very difficult to make money with long only bots at this point. So this is where margin trading comes in very, very handy. And the reason that I've introduced this using this adjust position is because there's a couple of interesting things as to why margin trading or using adjust position is a lot more convenient, which is two parts. One is that you only need to set a target rather than thinking specifically about which orders to place. But it's also that there's a strong relationship between this target and the actual kind of risk in the market. So if you have a target, or if you set a weight on an asset of 1, if that asset then moves by 5%, then your portfolio will move by 5%. So also there's a very strong relationship basically between what this is known as the target, also known as the leverage ratio. But the leverage ratio is very, very strongly related basically to your actual kind of outright risk. And this becomes quite important when you're taking short positions. So we have this simple bot basically just following a zero lag moving average convergence signal. So if we want to then convert this to a margin bot, what is needed? So the first thing we want to do is add an annotation to the initialize. All the functionality for margin trading is available in the documentation. There's a section here for, this is just some general points about margin trading, what actually happens in a short. When you're shorting, you're borrowing something and selling it. Also, you can kind of borrow the quoted asset to kind of take on extra risk. So there's a lot of information in here just about maintaining margin levels, what happens in terms of liquidation, and if trades go against you, how to manage short risk and leverage risk, and about loans, repayments, and interest. And then there's some example bots in here as well. Also within the API, we have the margin section. So all of the specific functions which are related to margin trading require you adding this enable margin trading function. Otherwise, all of it will fail if you try and run it live or run it in backtest. So all of this is separated out, and we need the enable margin trading to actually to use it. So what we're actually going to use is this margin adjust position. So this is interesting because adjust position allows you only to take basically values of 1 to 0. So that's basically fully invested in the asset or fully divested of the asset. So the interesting thing with margin adjust position is that you can take a position from 3 to -2. So negative is short positions, and greater than 1 is basically leveraged long positions. So it really is a simple now of just using margin adjust positions. And here, where we would be basically getting completely out of the position, we would just be taking a negative position. Now this is completed, we can see that basically if we look at the previous results, you can see this trades obviously a lot more frequently. It makes, well, double the returns, but also the Sharpe ratios are better as well. So we can see the flat spots during the bear markets are obviously no longer there, but you can actually see as well the strategy is now able to actually generate profits in a bear market rather than staying out of the market entirely. So there's a couple of things I also kind of wanted to just mention in regards to, I mean, the reason that we can see lots and lots of trades here is because we're trying to set a certain target weight, and one of the things that basically happens when you in long positions, when you're making profit, what will actually be happening is you're no longer kind of achieving that target weight. So what it's actually doing is just trying to sell off some of that excess position in the long position. And you'll notice this kind of happens more if you have a leveraged long position, because if you have borrowed against your position and bought some Bitcoin, as the value of Bitcoin goes up, your risk and your leverage actually goes down. The reason being is your collateral is worth more because of your long position, but your loan is in the quoted value. So the quoted value has not changed, but the actual value of the collateral has. So in that case, what you would actually want to do to maintain the same leverage and same risk is actually be adding on to the position as it goes in your favor, and vice versa. So the reason this can be a little bit more risky in a short position is if you're short and the market is going up, the value of your loan, or the value of what you borrowed, is going up at a faster rate than your collateral. And because you sold what you borrowed to cash, the value of that doesn't change, but the amount that it would cost you to actually rebuy back what you borrowed increases in size. So your risk actually increases as the position goes against you. So for that reason, and the reason I added volatility here, is one simple trick for adjusting that is basically setting a risk target. So we can kind of see the kind of average risk here is between basically 3 and 7%. So we can say that, you know, we don't want to take any more than, say, 3% of risk per day. And then what we can actually do is divide that by the volatility. So if the volatility is actually 6% and we only want to have 3%, then we should only take half a position. And then we can basically just set this to a minimum of 1.0 or a max of so that'll just make sure that that adjustment is basically between 0 or 1. So it'll take a maximum of basically the full leverage, or it'll take the minimum. So what this will do is when you are in a position, or when the volatility basically increases significantly, or if you're taking more risk than you would like, then it would actually reduce the risk. So for instance, if you're in a short position and it's going against you, it would actually be reducing the risk that you have while trading. And this risk target will kind of allow you to set some ideal limit of how much you'd like your portfolio value to change by, depending on what's actually happening in the market exchange. So if the volatility increases significantly, it would reduce the position size that you have, and thus keep your risk within kind of manageable limits. So a couple of the other things to kind of discuss once this backtest is run is also kind of monitoring some of the actual values associated with margin trading. So the balances have changed. So the balances not only contain free assets and locked assets, but it also has borrowed assets and interest. So it's always worth keeping an eye on whether or not you've actually borrowed quantity. We can plot that, and then we can also look at the margin level, which is basically the ratio between the assets that are owned and the assets which are owed. And what you want to, basically, if that ever goes too low, you'll be liquidated, and that's generally a very expensive thing to happen. So we want to avoid that at all costs. So what we can do here, query times borrowed. So we log that. Currently this is called margin ratio, but this will be soon called margin level. And we want to basically just take the minimum between, The reason being, this number can be very, very large, so if you just plot it otherwise, you can't see everything. So what we can see now after the backtest has run is we can see the amount that we've kind of borrowed in terms of Bitcoin. So when we have short positions, we can see there's some borrowed. And what we can actually see is our margin ratio dropping. So when we have basically a 2.5 margin ratio, that means that the assets that are owned are worth 2.5 times the amount that we're kind of borrowed against. So this margin ratio, it's generally bad for it to be below probably 2 or definitely below 1.5. Binance stops you from trading anymore. That's when you've hit your margin level limit. So, and then we can also see basically the weight, and this is the percentage of the account that's kind of allocated to Bitcoin. So we can see that being long and short. If we wanted to trade a little bit less, I mean, it's relatively simple to do, but we can actually just set that to be basically like a percentage of the portfolio value. So what we're then basically saying is that we only want to rebalance if the amount of trade size is more than 33% of the total portfolio value. So that just avoids doing lots and lots of small trades that are just trying to change the portfolio value by a small amount. You'll notice that all of the small trades are now gone. And then we'll notice it does many less trades. The Sharpe ratio has increased, the total return has also. So hopefully this video has helped you to understand margin trading and how it can be used, and how to take a spot only bot and modify it to use margin trading. Hopefully you also got an idea of how to kind of measure risk, and it's worth, with margin trading, actually keeping an eye on the risk and just understanding what is the potential volatility of the value of the portfolio as a function of the asset volatility and your position weights. And then also just understanding this margin adjust position function and how that works basically to try and position the portfolio given the target. So thank you for your time. Good luck. Goodbye.